A person can hold a massive fortune on paper, yet face sudden bankruptcy simply because they cannot pay an unexpected $10,000 tax bill. When an emergency strikes, wealth locked inside physical assets becomes entirely useless if the vault door slams shut before you can reach it. Take Sarah's portfolio as an example. She owns a house worth $200,000, $1,000 in physical gold, and $1,000 in a checking account. If an unexpected medical bill arrives, her total net worth of $202,000 will not save her. Surviving this moment depends entirely on the structural architecture of those three specific assets. This is the core concept of liquidity. It defines how quickly and easily you can convert an asset into cash without having to slash its price to attract a buyer. Evaluating financial health purely by calculating net worth is a dangerous illusion. Cash serves as the ultimate safety net, specifically because it has zero conversion time and zero friction to deploy. Every single thing you own, from a standard bank account to heavy physical investments, comes with its own unique barriers to selling. This diagram plots barriers along the liquidity spectrum. At the extreme, very high end, we have cash and savings accounts. They serve as the baseline of immediate utility because you don't need to find a buyer or negotiate a price. Gold is highly valuable, but it lands here in the medium zone. If you need cash, you have to physically transport the metal to a specialized dealer to convert it. That introduces slight friction into the process. Real estate plummets to the low end. You will likely lose weeks or even months searching for a buyer, negotiating offers, and executing legal paperwork before you can actually access the value of your property. Every physical and digital asset sits somewhere on this continuum. The harder it is to find a buyer and clear the paperwork at a fair price, the lower the asset's liquidity. Moving up to the macro level, we see how global stock markets bypass these barriers entirely. Millions of shares are traded daily in a hyperactive environment. Three specific conditions make these markets highly liquid: an enormous volume of active trades, an abundance of eager participants, and exceptionally tight margins between what buyers offer and sellers demand. If high liquidity guarantees immediate safety and low friction, why would any investor ever choose to buy an illiquid asset like real estate or fine art? This graph charts a fundamental law of finance, the strict trade-off between liquidity and profitability. Notice the clear inverse curve. As the liquidity of an asset decreases, its potential return rises. Investors demand higher potential returns as direct compensation. If they are going to lock up their money and surrender their emergency access to cash, the asset must promise a larger ultimate payoff. The math forces a choice. Achieving maximum financial safety requires holding cash, which guarantees minimal growth. Conversely, pursuing massive growth requires sacrificing the safety of immediate access. This dynamic scales up directly to massive corporate operations. For large companies, the precise speed of cash flow strictly dictates daily survival. Businesses face a relentless cycle of short-term obligations: employee salaries, supplier invoices, and monthly rent. A company cannot pay those bills with a fraction of a factory floor or a warehouse stacked with unsold inventory. To prove a business can survive the immediate future, financial professionals rely on mathematical stress tests called liquidity ratios. This visualization shows the current ratio. Dividing current assets by current liabilities shows if a company can cover impending debts. The quick ratio is a stricter metric. By visually subtracting inventory, it proves survival using only immediate cash and receivables. Strategic financial health requires a deliberate architectural balancing act. A business must keep exactly enough liquid assets available to eliminate the risk of short-term ruin, while confidently locking away the rest of its capital to capture long-term growth. Liquidity is simply the speed of fair price conversion. Mastering this balance is the only way to survive the present long enough to profit in the future.